Hey, good morning, investors. You've got Colby, the DGI Crab here, coming to you on a Monday morning, just about 9:30 in the morning U.S. Central Time here on Monday. Stock market is crashing, it's recovering, it's crashing. The Fed may be cutting rates. Iran might be going to war with Israel. There's problems in the Japanese banking system. Everybody's money's on fire. Oh my God. Calm down, everybody. Just calm down. I had some content planned for this morning, but I decided to hold off on that and just do more of a live conversational style of video here for you to basically talk you off the ledge. So, listen, something that Dave Ramsey says a lot of the times is the only people that get hurt riding a roller coaster are the people that try to jump off in the middle. It's basically a metaphor for people who panic when the stock market goes down and they just sell everything that they've got. Sometimes even for a loss at that point, they're panicking. They think that the market's about to just crash and burn and go down, 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 down. And hey, maybe it's going to for a little bit. Who knows? Am I worried about it? Not at all. Not at all. Not whatsoever. That is one of the great things about being a dividend growth stock investor. So I just want to go over a couple of quick things with you here today, just to give you some perspective. I know that when the markets are going down, it look and things can look really scary, but I don't want anybody that watches this channel to be of the mindset to panic. Let's go back over our four tiers here just very quickly. I know I do this for you on Friday, but if you'll compare what's going on here with these prices that are being updated live based on what was going on Friday, do you notice anything different here? I don't notice any major differences. I still see Nike is generally really undervalued. I still see almost every other stock in this category being overpriced. Microsoft, for example, at one point this morning went all the way down into the 380s. Now, if you're a day trader and you were buying Microsoft a week or two ago at $450 a share, thinking that you were going to flip it because Microsoft tends to just go up pretty consistently, you're kind of panicking this morning because your portfolio, or at least that part of your portfolio, is down well over 10%. If you are the type of investor that I am, and you're looking more at the passive income that an individual stock is going to generate for you, and you're only buying it when it is very underpriced, which to me, underpriced is for your average yield compared to current yield, you were staying away from Microsoft when it was in the 450 range. And you know what? Now that it's corrected down into the 380s, 390s, you're still staying away from it now because it still looks a little bit overpriced. Now, I'm not a professional financial advisor, so you should always do your own due diligence and make up your own mind when it comes to investing in any stock, any security, or whatever. This is just one crab's opinion, one DGI crab's opinion, but I don't see a lot of changes here on the tier one. Do I see major changes in the tier two? Not really. Still see the same three stocks here, Starbucks, Target, and Hershey, that look like they're in that buy zone. Most everything else is here in the red. Tier three, same two stocks in the buy zone. Archer Daniels Midland, Hormel Foods. We're seeing some other stocks maybe climbing the ladder a little bit in terms of viability to me. T. Rowe Price continues to drop down, crash back down to earth again. It's looking a little bit more viable, but I don't see a lot of major activity down here in the stuff that to me looks to be overvalued. Tier four, I still don't have anything in the buy zone in this group. One of the things that has a couple of stocks that have fallen quite a bit in this recent dip have been the BDCs, our business development companies. Ares Capital's down a fair amount this morning. Main Street Capital's down like 5%. Still looks overvalued to me. My top 10 stocks, my top 10 favorite stocks of all time. I don't have anything in the buy zone. Didn't have anything in the buy zone on Friday. Still don't have anything in the buy zone today, even though a lot of this stuff is down at least a little bit. So what does this tell me as an investor? Well, it tells me that the stock market has been on fire for most of 2024, and we are probably, regardless of what's happening in the world or what's happening in the country, are just due for a correction. This is healthy stock market activity. But DGI Crab, my portfolio's down 20%. What am I going to do? Well, if your portfolio's down 20% and you're a dividend growth stock investor, to me it means work some overtime and side hustle and get even more money into the market, because if the market continues to go down, 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 that's going to present buying opportunities for you, because you should not be overly concerned about this, about the current price. What you're concerned about is this, dividends per share, and whether or not the current yield that you're buying that passive income at today is a fair amount higher than what it's been averaging over the past 4 years. That is it. Now, I want to switch gears over here to this example portfolio. I did a video a week or two ago talking about the DGI Crab strategy and how it may look or operate in retirement, and why I like to invest in my personal style of investing, where I've got a few different ETFs that pay out dividends like VIG, SCHD, VYM, and some S&P 500, of course, as well. And then also a lot of just blue chip companies like McDonald's and Microsoft and Visa and Waste Management, etc., that are paying out passive income. And when I did that video a couple of weeks ago, the portfolio value was $650,000. So I thought, well, let me check back now that the market's dipped, and what would that hypothetical portfolio be worth right now? It's $630,000. Oh my God, I just lost $20,000. Calm down. You haven't lost anything unless you sold all of it. Think back during the 2008, 2009 financial crisis. Someone asked Warren Buffett basically, what his feelings were, because he had just lost like 50% of his portfolio's net worth. And he said, I haven't lost anything because I haven't sold anything. You don't lose unless you sell. You don't lose unless you jump off the freaking roller coaster in the middle of the ride. You know what hasn't gone down? This number. This is still down to the penny, the same amount that it was a couple of weeks ago. And if anything, it's probably going to go up and not down, because a lot of these companies, really most of these companies, are most assuredly going to increase their dividend. How do I know that? Because that's what they've been doing in most cases for most of these for decades. Coca-Cola, dividend king, 50 plus years of increasing the dividends. Johnson & Johnson, same thing. Procter & Gamble, same thing. Pepsi, automatic data processing. That's just what these companies do. Of the 60 high quality dividend growth stocks that I focus in on this channel for tiers 1 through 4, do you know how many of them cut their dividend in 2020 during the COVID crash? 0. Not a one. You know how many of them raised their dividends in 2020? All of them. All 60. So if you think back to the COVID crash in 2020, if you jumped out of the market in March or April because you were in a panic, and I understand being panicked, I don't like to see the overall portfolio value go down. There is a real psychological thing that happens even for somebody like me that's more concerned about the annual income number than the overall portfolio value number. It can be kind of scary to see the portfolio's value overall going down. But the portfolio value number isn't the number that a dividend growth investor cares about. We care about the annual income number and whether or not that's going up. Now, if all of a sudden 20 of the 60 stocks that this channel covers slashes their dividends, well, then maybe I'll be a little bit more in a panic. But it didn't happen in 2020, and it didn't happen in 2008 or 2009. Almost every single stock in this group of 60 raised their dividends in 2008 and 2009. Some less than others. A few of them couldn't, like the big banks. J.P. Morgan couldn't do that at that point in time, but almost every other one did. And that is the point of being a dividend growth stock investor. When the markets crash, you just kind of look around and you say, why are they crashing? We got to read a bunch of articles and figure it out. Not really. Not really. Is your annual income staying the same and going up? That's the number that I'm worried about as a dividend growth stock investor. So if the markets continue to crash and burn and go down over these next few weeks or even over the next few months, you know what my plan is? I'm going to work more. I'm going to work more hours. I'm going to side hustle my little crab butt off, generate even more money to put into these markets so I can make this number go up and buy high quality companies in a fire sale, get better deals on my ETFs that I dollar cost average into. That's the name of the game. Increasing your passive income, not being worried about the fluctuations of the market and doing all of this paralysis of analysis and freaking out about every last thing that's going on in the country or the world. It's a very, very low stress way to invest. Get over the emotions, everybody. It's going to be just fine. Even if the markets continue to tank, I'll be back here saying the same thing each and every time. So my name's Colby, DGI Crab. Email me your panicky questions at dgicrab@yahoo.com. I'll talk you off the ledge if that's what you need. Hopefully this video has been helpful for you. I'm going to include a link to each of the 4 tiers down below in the description so you can see how I constructed the 4 tiers, why I picked the stocks that I did that went into this group of 60 the channel focuses on, and maybe that'll calm you down a little bit if you can go over the history of a lot of these companies and see how they've continued to increase the dividends for their shareholders through thick and through thin for decades on end for almost all of them. Thanks a lot for tuning in, everybody. Stay calm. Patience and perseverance accomplish all things when it comes to investing. Just invest in blue chip quality companies, buy deals when they're available, and just sit and chill when they're not. It's as simple as that. See you next time, everybody.